Welcome to the Deep Dive. We dig through stacks of sources to pull out the key insights, hopefully arming you with knowledge for, well, just navigating this complex world. Today, we're diving into the mind of someone whose name is just synonymous with success, really, Warren Buffett. And, forget just the stock picks for a second. Our sources today paint a picture of almost a modern philosopher. His ideas on business, investing, even life, they're just incredibly consistent and pretty profound when you look closely. Okay, let's unpack this. When you hear Warren Buffett, your mind probably goes straight to the Sage of Omaha, right? Legendary investor, billionaire. But as we were digging into the material for today, what really jumps out is how his words, his annual letters, the interviews, they just resonate way beyond Wall Street. You've got entrepreneurs, students, people just trying to make smarter choices day to day, all paying attention. It really makes you wonder, how has one person kept such a clear, consistent philosophy going for decades? Through huge market shifts, tech booms, busts, economic chaos. And I guess more importantly for you listening, what can you actually learn from this seemingly timeless approach?
Well, it's fascinating, isn't it? Beyond just the sheer scale of his success, it really is that consistency you mentioned. Our sources kept pointing to this, his adherence to a core set of principles. Rather than, say, constantly changing tactics with the wind, it suggests a really deep philosophical framework guiding things. So our mission today, our deep dive, is to really explore these core ideas. We'll look at his foundational investment strategies, sure, but also his views on leadership, risk, how he thinks about market behavior. And we'll touch on the criticisms too. It's important to get the full picture.
Right.
The goal isn't just to list what he says, but to dig into why these principles seem to matter so much and maybe how they apply in the real world, helping you become more informed, whether that's for investing, managing something, or just making sense of it all.
And we've pulled from a lot today, sources covering his investment side, his management style, his economic views. Plus, of course, those famous quotes and some critical takes as well. So let's start with that idea, Warren Buffett, the modern philosopher. It sounds a bit grand, maybe, for a guy famous for making money, not, writing abstract texts.
Right.
But the more we looked, the clearer it became that his influence really does go beyond finance. It feels like a whole philosophy for business and maybe even life. He's not just giving stock tips. He's offering a whole way of thinking.
He absolutely is. The sources really stress how his wisdom connects with such a wide audience. It's not just finance pros reading his letters. You have, like you said, entrepreneurs looking for management tips, students wanting ethical frameworks, regular people trying to figure out their savings. That broad appeal suggests he's tapping into something, well, kind of universal. And that consistency, sticking to the same core beliefs for, 50, 60 years?
It's incredible.
Despite everything changing, computers, the internet, AI now, it really does point to this deep ingrained philosophy. It's not about chasing trends. It's about having this bedrock that keeps you steady when everything else is swirling around.
And that steadfastness, it just builds so much trust, doesn't it? In a world that feels, frankly, chaotic a lot of the time, with constant news about the next crisis or bubble, seeing someone stick to their guns, not get swept up by the crowd, it's almost reassuring.
It is.
And the fact that people from all sorts of fields are interested, not just finance types, it reinforces that people are looking for something more than just the next hot tip. They want wisdom, something that applies to, the bigger picture of making decisions.
Precisely. And that brings us right to why his principles seem so enduring. Why do things like patience, understanding the real value of something intrinsic value, and knowing what you own, why do these never go out of style?
Yeah, good question.
Well, think about it. Contrast that with market fads. Remember the dot-com boom?
Oh, yeah?
Or the housing craze before '08? Or even some of the meme stock stuff more recently?
Right.
Those things are driven by hype, by emotion, and they often end badly for a lot of people. Buffett's principles, though, they're rooted in, fundamental economic realities and human behavior, fear, greed, things that don't really change, the value of a dollar earned, what makes a good business good, the power of compounding returns over time. These are kind of universal truths, right? They work regardless of the latest tech.
So, okay, this philosophical approach, what does it mean for you listening? Beyond just stocks, how does thinking like this, with principles and a long view, help in other areas?
Well, I think it's about cultivating that deeper perspective, trusting fundamentals, whether you're looking at a company, picking a career, even deciding how to spend your time.
resisting the urge to chase the next shiny thing.
Exactly, or getting caught up in the crowd's fear or excitement. It suggests that a more deliberate, thoughtful path based on consistent values might be, well, more robust, a better route to long-term success and maybe even satisfaction than just reacting to every trend that comes along.
Okay, let's get practical now. Let's dive into the pillars of his actual investment success. These aren't just tips. They're like the bedrock of his whole approach to building and, maybe more importantly, keeping wealth. And a lot of this comes from his mentor, right? Benjamin Graham.
Indeed. Yeah, Graham's influence is huge. And the first principle, the most famous one probably, is value investing, buying businesses with strong fundamentals. So Buffett's strategy, which he definitely evolved from Graham, is basically about finding companies trading on the stock market for significantly less than what they're actually worth underneath, their intrinsic value.
Right, not just chasing what's popular today.
Exactly. He's not interested in short-term trends or hot stocks. He's looking for businesses that are fundamentally solid, good operations, consistent profits, some kind of edge, but that are temporarily cheap because the market's overlooking them, or maybe there's some temporary fear or just, irrationality. It's like finding a dropped wallet when everyone else is looking somewhere else.
And here's where it gets really interesting, I think. It's not just about finding a cheap stock. It's seeing the business behind the ticker symbol. Like you're buying the whole store, not just a little piece of paper that fluctuates. Our sources kept saying this cultivates an ownership mindset.
That's key.
And to figure out that intrinsic value, he's not just guessing. He's digging into the financials. Like how much revenue does it make consistently? What are the profit margins?
Right, and things like return on equity or ROE, basically how well the company turns shareholder money into more money.
Efficiency.
Yeah, efficiency. And maybe most importantly, free cash flow. That's the actual cash the business generates after paying for everything it needs to keep running and growing.
The real oxygen of the business.
Precisely. And this deep dive into the business itself is totally different from just speculating on price movements. It's about tangible, long-lasting value, not just buzz.
Okay, so you find a good business, you figure out its real worth. Then comes the margin of safety. A cushion against uncertainty.
Yes, this is absolutely crucial for Buffett. It's not just theory, it's practice. It means buying that stock at a price significantly below his own conservative estimate of its intrinsic value.
So you build in some room for error.
Exactly. That difference acts as a financial cushion, a buffer. Maybe your valuation was a bit off, or maybe something unexpected happens in the market. Think of it like, okay, you figure this thing is really worth £100 a share, but maybe because everyone's panicking, it's selling for £70.
Right.
That £30 gap is your margin of safety. You're essentially buying a £100 note for 70 quid.
Which sounds pretty good.
It sounds great. And it directly reflects his risk aversion, that famous rule number 1, never lose money. Protecting your capital comes first. But doing this takes real discipline and patience. You have to wait for the market to give you those opportunities, those mispricings, which often happen when fear is high and others are selling desperately.
That protection, that cushion, makes so much sense. Like building a bridge stronger than it technically needs to be, and that patience you mentioned. That flows right into the next principle. Long-term perspective. Investing for decades, not months.
Oh, absolutely. Unlike so many people in the markets today, Buffett's intention when he buys into a business he likes is ideally to hold it. Well, forever, as he says.
Forever.
Yeah. And this commitment lets the power of compounding really work. Compounding, for anyone unfamiliar, is basically earning returns on your return.
Money making money.
Exactly. Your profits get reinvested, and then they start generating their own profits. It's not linear growth. It's exponential. It snowballs over time. It's incredibly powerful.
And this long-term view, it's not just a tactic, is it? It seems tied to his belief in good businesses and, well, the U.S. economy specifically. That never bet against America idea.
It is. It's a deep-seated belief. He's seen generations of innovation and growth, and he has this fundamental faith that quality businesses, especially in the American system, will endure and thrive over the long haul. So the strategy encourages investors to, ignore the daily noise, look past the quarterly reports, the headlines, and focus on that underlying long-term value creation. It's really an act of faith in economic progress, letting time be your ally.
So what does this mean for you listening? It's about shifting from reacting to the day-to-day chatter to something, I guess, deeper. Letting your investments compound over the long run, like planting a seed and letting it grow, rather than constantly digging it up to see if it's sprouted yet.
That's a great analogy. And what he chooses to plant are companies with these economic moats. Sustainable competitive advantages.
Moats, like around a castle.
Exactly like that.
Yeah.
An economic moat is some kind of durable advantage that protects a business from competitors. It keeps them at bay, allowing the company to maintain profits over the long term. Without a moat, even a decent business can get overrun pretty quickly.
So what do these moats look like?
They can take different forms. One is powerful brand recognition. Think Coca-Cola or Apple. People trust the brand or loyal to it. That's a barrier. Another could be patents or proprietary technology that others can't easily copy. Or maybe significant cost advantages that they can just make things cheaper than anyone else.
Like a big retailer, maybe?
Yeah, could be. Or network effects, where the product gets more valuable as more people use it. Think social media platforms or credit cards. It's hard for a newcomer to compete when everyone's already using the established network.
Right, the value is in the network itself.
Precisely. So focusing on moats forces you to look beyond just the recent numbers and analyze the structure of the business, what really protects its future profits.
It's about finding businesses that are genuinely hard to compete against, which ties right back to that idea of intrinsic value in buying a business, not just a stock. Intrinsic value, it's like, what's the real soul of this company, ignoring the market's daily mood swings? If the stock market closed for 10 years, as he sometimes says,
right,
would you still be happy owning this business? Buffett looks past the ticker price and asks, what's the actual engine here? What's its real earning power, its sustainable edge?
He analyzes the financial health, but also future earnings potential, growth prospects. He keeps saying, think like a business owner. Focus on the underlying economics, not the stock chart.
And that benchmark, that intrinsic value estimate, helps you avoid overpaying when everyone else gets excited, right? Buying hype instead of value.
Exactly. Which leads us to the final core principle here. Operating within your circle of competence. Investing within your knowledge.
Ah, yes, the circle of competence.
It's simple, really. Only invest in businesses you actually truly understand. He stresses that the size of your circle doesn't matter nearly as much as knowing clearly where the boundaries are.
Knowing what you don't know.
Precisely. You don't have to be an expert in everything, but you absolutely need to be honest about what falls outside your understanding. Buffett famously stayed away from tech stocks for a long time, right? Even when they were soaring.
Yeah, people criticized him for that.
They did. But he said he just didn't understand their business models well enough, didn't see the durable moats. It wasn't about being anti-tech, it was intellectual humility.
Until Apple later on.
Exactly. He invested heavily in Apple later, but arguably only once he felt he understood it as a dominant consumer brand with a powerful ecosystem, something that did fit his framework.
So stick to what you know. Avoid speculating on things you don't grasp.
Right. It encourages informed, rational decisions based on real understanding, not just tips or trends.
That's such a powerful lesson, way beyond just investing. That intellectual honesty, knowing your limits.
Yeah.
I think we've all, strayed outside our competence zone at times and regretted it.
I haven't. It makes you wonder, doesn't it? How often do we step outside our own circle in other parts of life, career moves, projects, whatever, just because something looks popular or we feel pressured? Buffett's approach is a really strong argument for sticking to your knitting, you might say, being deliberate and self-aware.
Okay, so choosing the right investments is one thing. But Buffett's philosophy, as our sources show, goes way deeper into how those businesses should actually be run. It's not just what he buys, but who runs it and how they do it. This seems absolutely crucial to Berkshire Hathaway's long-term success.
Oh, absolutely critical. He places enormous weight on management quality. He's actively looking for leaders who aren't just competent, good at their industry,
Right.
but who are also transparent, honest, and rational. And crucially, leaders who are deeply committed to maximizing long-term value for the shareholders, for the owners. He particularly likes what he calls owner-managers, people running the business who also have a big chunk of their own money tied up in it.
Skin in the game.
Exactly, skin in the game. Their interests are naturally aligned with the other shareholders. They're thinking long-term about the health of the business, not just next quarter's bonus or, empire building. So this focus on integrity, ethical behavior, it shows he believes trust is just as vital as financial results. A brilliant manager who you can't trust is actually a huge risk in his book.
That's a great filter for anyone evaluating leadership, really. In any context. Look for that integrity, that long-term view. And for these leaders, Buffett says their single most important job is rational capital allocation.
Yes. He believes this is the CEO's #1 responsibility. deciding what to do with the company's profits. There are basically a few main options, right? You can reinvest the earnings back into the business to grow it. You can pay down debt. You can acquire other companies. You can pay dividends out to shareholders. Or you can buy back the company's own stock.
Lots of choices.
Lots of choices. And Buffett has strong preferences. He wants capital allocated to opportunities that promise high returns on the invested capital good ROIC and at sensible prices. The focus is always on increasing the long-term intrinsic value of the business, not just hitting some short-term target like earnings per share, which managers sometimes manipulate. His famous caution about acquisitions sometimes waiting years for the right deal, and his preference for reinvesting in strong existing businesses, it all highlights his awareness of the risks of, say, overpaying for growth, or chasing deals just for the sake of size. Every dollar needs to be put to work effectively.
Making every dollar count for the long haul. Makes sense. And beyond that, he's a massive advocate for strong corporate governance, ethics, and transparency.
Huge. He really pushes for practices that align the interests of the managers and the shareholders. It's not just a nice to have, it's fundamental. He demands ethical behavior, honesty, candor in communications. Shareholders deserve the straight story, he believes, even when the news is bad.
No sugarcoating.
No sugarcoating. And he has specific ideas about who should be on a company's board, too. He wants people with real business savvy, who think like owners, who genuinely care about the company's long-term future, and who will provide real oversight, not just rubber stamp management.
So active, engaged directors.
Exactly. It all comes back to this conviction. A well-governed, ethical, transparent company is just much more likely to create sustainable value over time. It builds trust, which is essential.
It is fascinating how much trust plays into his whole approach, which brings us to his own leadership style. Trust, autonomy, and long-term vision. People describe Berkshire's structure as very laissez-faire, almost hands-off.
It is remarkably hands-off, especially for such a huge conglomerate. He spends enormous effort finding the right people to run the subsidiary businesses, people he believes are highly skilled, ethical, and share his long-term vision. And once he trusts them, he gives them incredible autonomy. He doesn't meddle in the day-to-day operations.
Really? Just lets them get on with it?
Pretty much. It's not about micromanagement. It's about finding the right jockey for the horse, setting the right incentives, and then letting them run their race. He focuses on the capital allocation decisions at the parent level and trusts his managers to run their businesses superbly.
That's empowering.
It is, and it fosters a huge sense of ownership among those managers. His leadership is also defined by that relentless focus on long-term strategy, resisting short-term market pressures. And, he himself is a model of continuous learning. He reads constantly, absorbs information, and isn't afraid to change his mind if the facts change. Again, think Apple.
Yeah.
So this style, delegation, trust, long-term focus, continuous learning, it allows all these diverse businesses under Berkshire to really concentrate on building lasting value without getting distracted by Wall Street's quarterly obsession.
Okay, the markets, they can feel like a wild ride sometimes. Turbulent, emotional. But Buffett seems to have this incredibly steady way of thinking about risk and market behavior. It seems very conservative, very psychological, and always focused on the long game.
Absolutely. He starts with a very specific way of defining risk and avoiding leverage. For Buffett, risk isn't just price volatility, how much a stock bounces around.
Which is how a lot of finance theory defines it.
Exactly, beta and all that. But for Buffett, risk is the potential for permanent loss of capital. Can you actually lose your money for good? That's the real risk. This shifts the focus entirely. It's about preserving your initial investment above all else. That's rule number one.
Never lose money.
Never lose money. And because of that, he has this profound aversion to excessive debt, to leverage. Sure, leverage can boost your returns if things go well.
But it can wipe you out if they don't.
Precisely. It magnifies losses and introduces risks you can't control, especially in a downturn. So his approach is deep financial prudence. Berkshire always holds a ton of cash, very little debt.
Which isn't just cautious, it's strategic, right?
Right.
That cash lets him pounce on opportunities when others are broke or forced to sell.
Exactly. It provides immense optionality and resilience. It lets him be greedy when others are fearful, partly because he can be. He has the dry powder.
And this conservative, value-focused view makes him pretty skeptical towards market efficiency and market timing.
Oh, deeply skeptical.
Yeah.
He consistently dismisses the efficient market hypothesis, the EMH.
The idea that market prices always reflect all known information.
Right. The theory that says you can't consistently beat the market through skill because everything's already priced in. Buffett basically says, look at my track record, look at Graham's. He argues that markets are often not efficient. He believes inefficiencies are created by human emotions, primarily fear and greed, and that disciplined value investors doing their homework can exploit these inefficiencies.
So trying to time the market, jump in and out based on predictions, that's a bad idea in his view.
A terrible idea. He thinks market timing is essentially futile for almost everyone. Trying to guess short-term moves is a loser's game, he'd say. Focus on the long-term value, build in that margin of safety, and forget about predictions.
So if we connect this back, it's really about trusting your own research over the noise, over trying to guess the unpredictable future. His whole strategy depends on the market not being perfectly efficient.
Exactly. That's why doing the hard work of fundamental analysis makes sense in his world, because you can find value that the market hasn't recognized yet. And to make this idea of market irrationality more concrete, he loves using the analogy of Mr. Market. This came from Benjamin Graham, too.
Ah, yes, Mr. Market. He's quite a character.
He is. Imagine you have a business partner, Mr. Market, and every single day he shows up and offers to either buy your share of the business or sell you his share. But the prices he quotes are all over the place. They're driven entirely by his mood swings. Some days he's euphoric and quotes a ridiculously high price. Other days he's utterly depressed and offers to sell his stake for peanuts.
Manic depressive, basically.
Totally manic depressive and completely irrational, based purely on emotion, not on the actual value of the business.
So the advice is, use him. Don't be guided by him.
Precisely. When Mr. Market is despondent and offering you a bargain price for his share of a good business, Buffett says, be greedy, buy him out.
Take advantage of his pessimism.
Right. And conversely, when Mr. Market is wildly optimistic and offering a crazy high price to buy your share, be fearful, maybe consider selling to him. The key is seeing Mr. Market's quotes as an opportunity, not as information about the true value. You use his moods to your advantage. You don't let his moods infect you.
It's such a brilliant psychological tool, isn't it? For resisting that herd mentality, for keeping your cool when the market's going crazy.
It really is. It reframes volatility from something scary into something potentially useful for the rational investor. Much easier said than done, of course.
Of course. And underpinning all this, the long-term view, the patience, the contrarianism, is his fundamental long-term outlook on the American economy.
Yes, that never bet against America line. It's not just flag waving. It's a deep, abiding belief in the long-term resilience and dynamism of the U.S. system.
He really believes in its ability to innovate and grow over time.
He does. He acknowledges there will be downturns, crises, political problems, but he believes the fundamental engine, the entrepreneurial spirit, innovation, rule of law, will ultimately drive prosperity over the long run. This multi-decade faith is really the bedrock that allows him to hold investments forever. He's betting on the system's ability to generate wealth over time, which lets him ride out the inevitable bumps along the way.
You know, one reason Buffett's ideas have spread so far is just how well he put things. He can boil down really complex concepts into these simple, memorable quotes. They're not just catchy, they're packed with meaning. They're like little nuggets of actionable advice. Okay, let's unpack this. Buffett just has this knack for cutting through the jargon, the noise, with a few perfect words, often quite witty too.
He does.
We could probably do a whole session just on his quotes, but let's look at some key ones and what they really tell us about his philosophy.
And what's striking is the consistency, right? These aren't just random quips. They all fit together. They encapsulate his whole framework, applied again and again for decades.
Totally. Let's start with maybe the most famous one, on risk management. Rule number 1, never lose money. Rule number 2, never forget rule number 1.
Classic.
Sounds almost simplistic, right?
Yeah.
But it's foundational. It puts capital preservation absolutely front and center. Avoiding big losses is more important than chasing huge gains because lost money can't compound. It sets the whole tone.
It's the core of his conservatism. If you truly prioritize not losing principal, you naturally adopt things like margin of safety and a long-term view. Protecting the downside gives the upside, the compounding, a chance to work. So many people forget rule number 1, chasing quick profits.
Then on value investing. Price is what you pay. Value is what you get. This just nails the core idea. It forces you to separate the fluctuating market price tag from the actual underlying worth of the thing you're buying. What's the quality beneath the sticker price?
That distinction is everything, and it connects to his evolution. He refined this idea over time, which leads to the next quote on quality versus price. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Yeah, that's a key shift from maybe early Graham.
It is. It reflects his move towards prioritizing truly excellent businesses, companies with strong moats, even if they aren't dirt cheap. He realized a great business, compounding its earnings over years, will likely generate better returns even if you pay a reasonable price for it than a mediocre business bought at a deep discount. Quality pays off over time.
Okay, shifting gears to market behavior. Be fearful when others are greedy, and greedy when others are fearful.
The contrarian mantra.
Exactly. It sounds simple, but it's incredibly hard to do. It's about using market emotion to your advantage, not getting swept away by it. Having the discipline to buy when everyone's panicking and selling, and being cautious when euphoria takes over.
It's basically the operating manual for dealing with Mr. Market. It requires real emotional strength to go against the crowd like that.
For long-term investing, our favorite holding period is forever. Not much ambiguity there. It just perfectly captures his commitment to the ultra-long term, giving great businesses the decades they need to grow and compound, ignoring all the short-term noise.
It shows he's buying a piece of an ongoing enterprise, not just a stock certificate he plans to flip. It's about conviction in the business itself.
And related to that, on patience. The stock market is designed to transfer money from the active to the patient.
Ouch. That's a dig at traders.
It is. It highlights how crucial patience is. Success isn't about frantic activity, constant buying and selling. It's often about sitting tight, letting time do the work. The market rewards those who wait.
It implies that a lot of activity is actually counterproductive. Thoughtful inaction can be incredibly valuable.
Okay, on understanding risk. Risk comes from not knowing what you're doing.
So important.
Yeah, this reframes risk completely. It's not about market volatility. It's about your own ignorance. It hammers home the importance of that circle of competence. Real understanding is what reduces risk, not just wishful thinking or following tips.
If you truly understand the business, its risks, its economics, you're inherently safer than someone buying something they don't get, no matter how stable the price seems today.
Another great one on long-term commitment. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years.
That's a tough test.
It really forces you to focus on the underlying business quality, independent of the stock price or whether you can sell tomorrow. Do you believe in the company itself? Would you want to be a private owner?
It separates the true investor from the speculator who needs that constant price quote and liquidity. It demands that owner's mindset.
And for dealing with the inevitable ups and downs on market volatility, look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it.
Turn lemons into lemonade.
Exactly. It encourages you to see downturns not as disasters, but as opportunities, a chance to buy quality assets on sale because others are panicking. Profit from their folly? Don't join in.
It's an empowering way to think about something that usually causes anxiety, turns fear into a potential advantage for the rational mind.
And lastly, just a beautiful metaphor on the power of time. Someone's sitting in the shade today because someone planted a tree a long time ago.
Lovely.
Just perfectly captures compounding, doesn't it? The benefit of starting early, being patient, letting time and reinvested earnings work their magic. Big results often come from small, patient beginnings.
These quotes, really, they aren't just sound bites. They weave together into a coherent, consistent philosophy that he's lived by for, well, a lifetime. Their relevance across different times just shows how enduring these core ideas are. They offer a whole worldview, really.
Now, while Buffett's philosophy is obviously hugely successful and widely admired, it's not perfect, right? Definitely faced criticism. And there are nuances we need to consider to get the full picture.
Oh, absolutely. No approach is infallible, and it's crucial to look at the counterarguments. One common critique, especially during hot markets, is underperformance, during bull markets and missed opportunities. Berkshire has, at times, lagged behind the broader market indices, particularly when things are really ripping higher, often driven by tech or more speculative areas.
Right, his conservative style maybe holds him back then.
Critics argue exactly that his focus on value, his aversion to high-growth stocks he doesn't fully understand, means he misses out on some big gains when the market's in a speculative frenzy.
And the big one there was tech for a long time. He got a lot of flack for missing the early internet boom, for example.
He did. His skepticism about tech moats kept him out of companies that generated enormous wealth. Now, his later huge bet on Apple complicates that narrative.
Yeah, suggests he adapted, maybe saw it differently.
Perhaps. Maybe he saw Apple's brand and ecosystem as a moat he could understand. But the criticism highlights a real trade-off. Strong risk management often means sacrificing some potential upside, especially in those really fast-growing, maybe riskier sectors. It's a balance.
Which leads to another big debate, the diversification debate. Buffett famously advocates for concentrated portfolios, big bets on a few companies you know really well.
Right. Put your eggs in a few baskets, but watch those baskets very carefully.
Most financial advisors, academics, they preach the opposite.
Right.
Diversify widely. Don't put too much in any one thing.
Exactly. The standard advice is that diversification reduces risk without necessarily hurting returns, the so-called free lunch. They criticize Buffett's concentration as being too risky for most people.
So how does he respond?
Well, he's famously said diversification is protection against ignorance, meaning it makes sense if you don't have deep knowledge. But he argues that if you do truly understand a few exceptional businesses, concentrating your capital in them can actually be less risky and lead to better results than owning tiny bits of many things you don't understand.
So it's about knowledge and conviction versus spreading bets.
Pretty much. It highlights a fundamental difference in philosophy, risk tolerance, and maybe perceived expertise. It's not necessarily that one is always right, but there are different approaches for different levels of understanding, perhaps.
And that level of understanding, that brings up the practical challenges in implementing Buffett's philosophy for smaller investors. His principles sound great, but can the average person actually do this stuff?
That's a very fair question. Calculating intrinsic value accurately, that takes serious financial skill, data access, time, things most individual investors just don't have.
Yeah, it's not simple.
It's really not. Identifying those wonderful businesses at fair prices, understanding their moats, that requires deep time-consuming research. It's practically a full-time job.
So what does this mean for you listening if you're inspired but maybe don't have that time or expertise?
It means that while the principles are invaluable for thinking about investing, the direct application might need modification. And recognizing this, Buffett himself often recommends something different for most people.
Which is?
Low-cost index funds. He's repeatedly said that for non-professionals, buying a simple S&P 500 index fund is probably the best bet. It gives you broad diversification, tracks the market, and avoids the pitfalls of trying to pick stocks without the necessary tools or time.
So even the master acknowledges that his specific method isn't necessarily right for everyone. That's quite humble, actually.
It is. It's a pragmatic recognition of reality for most investors. The principles inform, but the practice might look different. Hashtag tag outro. So, wrapping things up, Warren Buffett's impact clearly goes way beyond just finance. You could genuinely call him a modern philosopher, offering these enduring principles for business, investing, and maybe just decision-making in general. His core investment ideas, value, margin of safety, long-term thinking, moats, intrinsic value, they create this really solid framework, not just for making money, but for keeping it. If you step back and look at the big picture, his legacy feels less about predicting markets or finding secret stocks and more about this timeless, disciplined, rational approach, understanding value and understanding really how people behave.
Yeah, and beyond investing, his ideas on management quality, leadership, smart capital allocation, ethics, trust, autonomy, they offer real lessons for building any kind of sustainable, successful organization, big or small. And his takes on market behavior, Mr. Market, skepticism about timing, they're constant reminders to stay rational, think long-term, and avoid those emotional traps the market sets. Sure, there are criticisms, and yeah, it's hard for individuals to replicate exactly what he does, but the core relevance, the practicality of his main ideas, it's undeniable. His wisdom continues to guide, generations of investors and leaders. So given everything we've unpacked today, all this wisdom, if Buffett sees risk as not knowing what you're doing, maybe the final thought for you is this: what area of your life, your investments, your career, your time might benefit from a deeper dive into your circle of competence? Where can you gain a truer understanding of the underlying value or the real risks involved? Something to think about. Keep learning, keep questioning, keep deep diving.